What's up everyone? Welcome back to Jay Get It. Let me ask you something. How much money do you really need to buy a house? 3%? 5%? 20%? And what about PMI? Most people hear random advice online and end up confused. So today, I'm breaking down what a down payment actually is, the difference between 3%, 5%, and 20%, how PMI works, when PMI makes sense, and how to choose the right strategy for you. If you're a first-time buyer, this saves you months of stress. If you're a banker, this helps you coach members clearly. Let's get into it. A down payment is the money you contribute upfront toward buying your home. This money becomes your equity. Equity means ownership. The more you put down, the more of the home you immediately own. Your lender covers the rest through your mortgage. So if you buy a $400,000 home and put down $20,000, you're borrowing $380,000. Simple. Your down payment affects your loan size, your monthly payment, whether you pay PMI, your interest rate, sometimes how competitive your offer looks. It's not just about getting approved. It shapes your entire mortgage experience. Let's start with the smallest option. 3% down on a $400,000 home, that's $12,000. This is common with first-time buyer programs. Pros: gets you into a home faster, requires less savings, great for renters ready to stop paying rent. Cons: higher monthly payment, PMI required, less equity at purchase. 3% down is about speed and access, not perfection. This strategy works when you have strong income, your credit is solid, you expect future income growth. 5% is the middle ground. On a $400,000 home, that's $20,000. This option balances affordability with stability. Pros: lower PMI than 3%, slightly better rates sometimes. More equity, still achievable for many buyers. Cons: PMI still applies, requires more savings. 5% is popular because it reduces risk without requiring massive cash. Now let's talk about the famous number. 20%, on a $400,000 home, that's $80,000. This is the traditional gold standard. Pros: no PMI, lowest monthly payment, strongest offers, immediate equity. Cons: takes longer to save, ties up cash, delays homeownership. 20% is powerful, but not required. Many buyers wait years trying to reach this number and miss market opportunities. PMI stands for private mortgage insurance. It protects the lender, not you, when you put down less than 20%. Think of PMI as a risk fee. Lower down payment equals higher lender risk. PMI helps offset that risk. Typical PMI ranges from about 0.3% to 1.5% of your loan annually. That's usually $100 to $300 per month depending on loan size and credit. Here's something important. PMI is not always bad. If PMI allows you to buy sooner, stop paying rent, start building equity, benefit from appreciation, it might be worth it. Many buyers pay PMI for only a few years. Once you reach 20% equity, PMI can often be removed. This is a strategy conversation, not a fear decision. PMI doesn't have to last forever. You can remove it by paying down your loan, home value increasing, requesting PMI removal, refinancing later. Most conventional loans allow PMI removal once you hit about 80% loan to value. Bankers, this is a key coaching moment. Buyers need to know PMI is temporary. Let's look at real numbers. Home price: $400,000. 3% down. Down payment equals $12,000. Loan equals $388,000. PMI approximately equals $200 per month. 5% down. Down payment equals $20,000. Loan equals $380,000. PMI approximately equals $150 per month. 20% down. Down payment equals $80,000. Loan equals $320,000. PMI equals $0. Each option changes cash needed and monthly payment. There is no best option. There is only the best option for your situation. Here's what trips people up: waiting forever for 20%, forgetting closing costs, draining emergency savings, not asking about PMI removal, not comparing programs. Buying smart beats buying perfect. For bankers watching, stop saying, "You need 20%. Instead say, "You have options." Explain PMI, equity growth, program differences, cash reserves. This builds confidence and moves buyers forward. Ask yourself, can I afford the monthly payment? Do I still have emergency savings? How long do I plan to stay? Is PMI temporary? Am I trying to buy now or wait years? These questions matter more than percentages. Down payments aren't about rules. They're about readiness. 3% gets you in. 5% balances risk. 20% maximizes stability. PMI isn't failure. It's a bridge. Use it wisely. If this helped you understand down payments and PMI, hit like, subscribe to Jay Get It, and share this with someone saving for a home. Drop a money bag if you're saving now, or house if you're close to buying. Next episode. Mortgage rate locks explained, when to lock and how it works. Remember, you don't have to be perfect. You just have to be prepared. Disclaimer. This content is for educational purposes only and is not financial, legal, or investment advice. Please consult a qualified professional before making any financial decisions.